Hi and welcome, ladies and gentlemen. Thank you all for joining us today for this afternoon's webinar. We have with us CSOP Asset Management today, and they are here to share with us about their soon-to-be listed CSOP iEdge S-REITs Leaders ETF. S-REITs form a significant portion of the Singapore market, and despite the downturn and the impact from COVID, their diversified nature in terms of their subsectors has played a part in their resilience last year. How will this new ETF help you to tap into this S-REITs? I'll hand over the time to Adrian at CSOP Asset Management today to tell us more. Adrian, please.
Yes, thank you, Jonathan, for the kind introduction. And let me just get the slides up. Okay. Yes, and thank you everyone for sharing a precious afternoon with us today, giving us a precious opportunity to talk about upcoming ETF by the name of CSOP iEdge, Singapore REITs Leaders Index ETF. How this ETF is going to help the investors to ride the wave of the economic reopening and also for long-term investments. Right. So this webinar will probably take about 20 to 25 minutes, just to cover the big macro picture why we should look at Singapore REITs right now. And also we're going to tell you more about the index that the ETF is tracking, the Singapore S-REIT Leaders Index, which offer investors scale, liquidity, and diversification. And how, if you were to buy into a basket of Singapore big and mid-cap S-REITs, you can actually use our CSOP S-REIT Leaders ETF, offers investors easier access to the real estate market, and also E being a cost and tax effective tool to invest into Singapore REITs, tradable for T, and also very transparent in terms of how we operate this ETF, and also very flexible because it's as an ETF, exchange traded funds, is listed on the SGX. You could actually invest in and out on an intraday or as and when based on your investment objective and period. You could get in and get out very easily with any brokerage account. So what is a Singapore REIT, right? So a REIT is actually a company listed as a unit trust that owns and operate income producing properties, such as retail malls, apartment buildings, warehouses, data centers, and hotels. So this is some of the subsectors that REITs were managed into and being categorized. Now, is real estate investment trust that's actually listed in Singapore. We call it S-REITs for short, and it's actually regulated by MAS under a collective investment scheme regime in the Securities and Futures Commission. So these REITs are actually being regulated by our regulators. Now, everybody knows about REITs, but what is the structure of a Singapore REIT? Is that Singapore REITs actually listed on Singapore Stock Exchange, and investors could buy in and buy out REITs, right? And these REITs are actually being managed professionally by a REITs manager. You have a trustee that actually look after the unit shareholders as us as investors, right? So the REITs itself owns a portfolio of properties, and there's a property manager likewise to manage physically the upkeep of the properties. Now, most importantly, that most of the investors do not know is actually the sponsors. The sponsors are very important in terms of a REIT, right? Sponsors may own a substantial stake in the REIT. They also typically own both the REITs and the property manager itself. I will share more in details why sponsors is very important in terms of a REIT itself, right? And investors holding on to a REIT can enjoy liquidity into real estate exposure, trade easily like a stock on a Singapore Stock Exchange, and also tax exemption, right, in terms of dividend payments, and also enjoy price appreciation in that sense. Right? Why Singapore REITs, right, offers attractive dividend yield and yet lower volatility. Under the Singapore regulations and by IRAS, our tax revenue regulators, that at least 90% of the income in terms of rental collected by the REITs manager has to be distributed to unit shareholders. And hence, that's the reason why he has offered, the very attractive dividend yields, and he has actually become one of the preferred asset class for investors recently. Right. Looking at the index itself, the iEdge Singapore REITs Leaders Index offer a 5.1% dividend yield, comparing to Singapore STI index, which comes in about 3.5. The 10-year government bonds by Singapore is about 1.6 in terms of coupons. The Singapore fixed deposit rate is about 0.2. And looking at our MAS published core inflation rate of 1.1, you could see why they offer the terms of yield spread, dividends yield spread for Singapore leaders comes in about 1.5% to 3.5% difference, and hence that's the reason why it has become a very attractive asset classes to investors. Likewise, in terms if you were to put the index against the rest of the performers, such as the traditional big global indices and other REITs index, you could see that looking at the 90-day volatility period, you could see that the Singapore REITs index has one of the lowest volatility, right, and yet offer very close to 4.5% in terms of dividend. So you could see that lower volatility, higher dividend yield, and that's the reason why it's still meant as one of the preferred asset class for investors, be it institutions or retail investors. And also, S-REITs is actually a good hedge against inflation, right? We expect, in fact, the markets believe that inflation is expected to rise when the economy starts to recover and starts to expand. And S-REITs can act as a good hedge against inflation based on the two different reasons. Rental is actually the composition of the CPI, which is the Consumer Price Index. Higher inflation means we have to have higher rents, and higher rents means higher income, rental income for the REITs manager, and 90% will be distributed to the unit shareholders such as us. Hence, it's a very good hedge against inflation. And we expect dividend yield to rise in the next 2 years, which is going to be actually much higher than the estimates of the Singapore inflation rate. In 2021, it's estimated by Bloomberg that this index, our index, which is the iEdge S-REIT Leader Index, will come in at 5.1%, and subsequently 5.4 and 5.6. This is again by Bloomberg estimates for work year 2022 and 2023. So we could see that the yield is continuing to rise as the economy reopens itself. And Singapore REITs market is growing and is attracting a lot of fund inflows, right? We can see that the market capitalization for Singapore REITs has actually grown an average of 11% for the last 10 years. Singapore REITs market in Singapore right now is actually one of the largest REITs market in Asia, right? With 40%, about 45% of the Singapore REITs IPO has actually been listed on SGX in 2019. This growing market will definitely attract more fund inflows, and we could see that there's actually a huge obvious fund inflows right now, be it the large institutions and the retail investors coming back into Singapore REITs. And you could see a huge inflow, especially for the last 3 months in July, August, and September. More net fund inflows are coming in. The institutional big boys has been a net seller for the early part of the year, but you could see they are piling back into Singapore REITs as well. So again, there's a structural tailwind to continue to push up the market cap of Singapore REITs. Right. So over the last 10 years, data has shown that Singapore REITs leaders, the big and the large cap and the mid cap leaders, this index has actually have offered investors an annualized return of 10.7%, and over the 90-day period, right, is about 10.5% in terms of volatility, outperforming other major indices and major REITs indices. And you could see this line, this chart over a 5-year period, right, that the iEdge S-REIT Leaders Index total return, which means price appreciation and dividends, actually have outperformed the rest of the global REITs indices, right? True enough, in 2020, at the start of the pandemic, it was a difficult period for everyone. Most of the REITs markets indices has fallen as the world clamped down and slowed down in terms of humans' activities. But you could see that the leaders, the large cap and the mid caps leaders, S-REITs, has actually rebounded so much faster than the rest of the world, and continue to outperform the rest of the REITs indices globally. Right, so we expect the iEdge S-REIT Leaders Index to deliver about 5.4% yield in 2022 work year, and also 5.7% growth for the same year as well, based on Bloomberg estimates. So to summarize this small part is that why we should invest into S-REITs and S-REIT leaders, especially right now, because they offer stable dividend yield and yet, relatively lower volatility, right? It outperforms other yielding product. For the last 12 months, S-REITs has delivered a return of 5.1% dividend yield compared to STI, which is 3.5, and the 10-year Singapore government bonds at 1.6. So we're looking at a yield spread of about 1.5% to 3.5% in that case. Providing diversification among other asset classes. So S-REITs has actually very low correlation with stocks, and with bond offers a diversification benefit if you include that into your portfolio. In terms of the property exposure, right, it provides stable income with global diversification. Now, S-REITs itself, even though listed on Singapore Stock Exchange, 80% actually invest into assets outside Singapore, right? We believe that right now the domestic assets are actually far and few. Even if they do have any deals going on in Singapore, it probably be a piecemeal size of deals. But right now, S-REITs are actually expanding outwards geographically. So right now, right, not only in terms of diversification, in terms of asset class, in terms of property exposure, geographically, you also have diversification in that sense. A good hedge against inflation. Higher inflation typically leads to higher rents. Definitely going to be positive for REITs because higher rental give us higher distribution income to the unit shareholders, right? The last but not least, S-REITs is definitely going to benefit from the global recovery as we move from a pandemic to an endemic phase with COVID-19. So this is why we should look into S-REITs right now. So why S-REIT Leaders Index? It's about scale, it's about liquidity, and it's also about diversification that's offered to investors. Right, so just a bit more of the index, right? Set up in 2014 in March, when this inception of this index, right? Right now, this index has about 28 names. The total market cap is $103 billion as of September. Now, what of the universe of over 40 REITs, right? What can go into this index? It has to be he has to meet this REITs has to meet a certain liquidity criteria. That means that the average traded value has to be more than US 500,000. The daily traded velocity of more than 0.1%. This shows that there's a lot of trading activities going on for these S-REITs, right? And it also has to have a free float criteria, which means it's owned by public hands of more than 20%, and of this 20%, it has to be of a value of more than 500 million Sing dollars. So this should ensure that there's actually free float in the hand of publics, right? The special thing about this index that I prefer and I like most, and why we decide to as ETF issuer likes to track our ETF with this, is because how it's being weighted is actually based on the liquidity adjustment, right? Which I will share more in details. Right, and the cap for each security is at 10%. There are two currencies, US dollars and Sing dollars. How we rebalance it is actually semi-annually in March and September. So after the recent rebalancing right now that we have done, right now the index is allocated more into industrial, which actually covers industries and logistics, and also covers data center as well. So if you combine these two subsectors, about 50% of this index is actually weighted into industrial and data center, which reflect the relevancy of tracking the new economy that has grown due to the COVID-19. And the rest are actually into multi-asset classes, healthcare, offices, retail, and logistics and hotel as well, right? In terms of the country geographical allocation, right? Singapore still holds a huge part, 64%. The rest are actually being spread out into Australia, United States, China, Hong Kong, and Japan, etc. Right. So now, first of all, we only want the big boys to be included into the index. Why do I want the big boys to be in? Due to the factor backtesting, and the data has showed that large and mid-cap S-REITs outperform greatly. If you look at the chart, the table at the bottom, at the right side, right, you could see that Q1 being the largest and Q4 being the smallest cap REITs, right? You can see that large cap has actually have a stronger historical return over a 10-year period. Annualized return is actually much higher than the smaller caps ones. Volatility is also lower. Very low average turnover, means that most of the investors are buying and holding these large and mid cap REITs and they're not selling it. And if you look through even the darkest period of time during the COVID as well, the maximum drawdown is actually 34% for the large and mid cap versus the small cap, which is actually very high. It's about 46 or 47% maximum drawdown. So, in terms of risk return profile, the large and mid caps offer a better risk return profile, right? Why we want the large and the mid cap REITs to be included in the index, right? It's because there's an importance in terms of scaling up. When you acquire properties, you become a larger, bigger market cap, more liquidity to the stocks, then a higher valuation, easier to raise equities and borrow more money cheaply, and then to buy more properties. So it's a virtuous cycle that the large advantage of scale advantage that these big boys have, and that's the reason why we want to put it into this leaders index. So again, just to summarize this small part is actually why do large and mid cap S-REITs outperform is because the sponsors, which I mentioned very much earlier, is that actually sponsors is very crucial in terms of the REITs, right? Most of the sponsors are actually government-linked companies with very experienced manager. And this big and mid-cap S-REITs has actually higher quality, newer, well-located and dominant assets versus the smaller cap ones, right? In terms of scale, when you're big, you have actually achieved operational efficiency, right? The sponsors pipeline and the global outreach definitely is there for them, for the big boys, right? In terms of yield spread advantage in the individual big REITs, right? It's because since you are scaled up, right? You're able to borrow cheaply, more efficiently in terms of both equities and debt. And we are borrow cheaply in terms of cost and higher rental. Definitely you have a better profitability for these REITs, right? And so just I could see that right now with this low interest rate environment, S-REITs are actually rushing overseas to acquire more properties overseas, as Singapore has actually a more limited domestic opportunities. So this allowed these S-REITs to continue to scale up rapidly, to compete globally for quality assets, to diversify in terms of geographical and sectors exposure, and that will actually cause a higher trading liquidity and a wider access pool of both institutional and retail investors as well. Next, I believe this is actually the most important slides that I'd like to emphasize to the investors and why this is very, very important and why we as an ETF manager would like this to be in our of this index, right? The index is actually created to represent the most liquid S-REIT markets. Out of the over 40 names of S-REITs, we want the most liquid one, right? And then, a liquidity enhancement is actually performed on these 28 names within the index. So again, based on the daily traded velocity, right? We will break down these 28 names into different quartile, right? So on the flip side, right, this liquidity adjustment was actually done on the 28 names. And how it's actually being done? If you have a very active daily velocity to your REITs, right, you have a higher adjustment factor when it comes to rebalancing. And those who are actually not very actively traded, not actively traded one, will have been the first quartile or the bottom 25%. We have a smaller adjustment factor. So least traded daily traded velocity will get a smaller adjustment. The high daily traded velocity will get a higher adjustment. This is actually what this does is actually the index will rebalance into REITs that are actually popularly traded, that will actually reflect the trend of the market and the market situation of this index. So this means that the index will continue to refresh itself to be relevant based on the market situation, and and put more weight into REITs that are actually mirroring to the market situation. So for example, the last rebalancing that we have done in September is that you can see that the top 5, the most liquid, most actively traded constituents. Like Suntec REIT, right, has a velocity of 0.89. That is actually about 9 times higher than the minimum of 0.1. So you could see that that is actually have an initial free float cap of actually 2.88 weight in our index due to this rebalancing that, there's a lot of people trading that Suntec REITs. Probably, and a lot of institution, a lot of retail investors, there's a lot of very good research reports about retail sector. So we could see that there's a lot of trading velocity and that we actually increase our weight after the liquidity adjusted and enhancements is actually being put to that S-REITs for that Suntec REIT. And you could see that increase the weight to by 1.35% and actually have about increase from 2.8 to about 4.2% weight into the index. Right, CICT again, actively traded for the last 6 months, and you can see that the trading velocity is at 0.48. You could see that right now it really, hit the top. It hit at a 10% cap. It has to stay at 10%, right? Capital DC REIT again, reflect the new economy data center. And you could see that for the last 6 months has been actively traded, right? So again, as the initial weight of 5.1% in the index have increased by 2.3% and actually have about 7.4% weight into the index as well, right? MLT logistics as well. Initially was, logistics has been benefiting from the new economy. Initially, it was actually about 8.8% weight in the index, has increased by 1.1%. It's actually reached a cap of 10%. So likewise, on the flip side, those are actually not very liquidly traded, right? Will actually have their. This shows that it's not a trend right now. It's not relevant. Some of the investors are not looking into those sectors. They have a reduced weight as well. So again, based on this rebalancing, the index is actually refreshing themselves on a 6-monthly basis, semi-annually basis to track the relevant market situation and also those very popular as Singapore REITs and also going into the momentum phase of these REITs. Right, and why is the liquidity advantage again on the ETF level, right? Looking through most of the individual REITs in terms of the bid and ask spread, so the buy and sell spread, right? You can see on the market level, the S-REIT market level, the average spread is about 50 basis points or 0.54%. So this why is very important because a wider spread will definitely eat up the returns, the total returns of the clients when they invest in and out of the market, right? And based on the average history of the 3 S-REITs, the 3 REITs within the market has been listed, you could see that right now the 3 REITs average spread is actually at 0.37 or 37 basis points. That is actually narrower than buying into individual REITs, and hence helps in terms of your total returns for your portfolio. Last but not least, diversification advantage, right? Buying into an REITs, ETF and into an index, you not only include cyclical REITs such as the retail and office, but also emerging REITs such as that benefited from a new economy such as data center and logistics. So these are by having said that, we are very overweight in terms of industrial and data center. We believe that office space and the retail space has actually bottomed up, and we see that especially for office, the grade A and prime offices will continue to increase. We'll probably see the worst days are over and see them benefiting from the reopening. And you could see that some of the examples are like MCT, Maple Commercial Trust, and K-REIT. And you see that K-REIT is actually one of those actively traded in the last rebalancing as well, and increase the weight for this index. Right, healthcare definitely stays as a defensive segment within the index because due to the COVID-19, healthcare has been the key sector as well. For hotel, we're definitely a bit conservative index sector, unless we can see more VTLs and more opening of our borders. Definitely, we see a pent-up demand rushing to hotel industries. Right. Also, if you were to buy into the index, a basket of S-REIT leaders versus buying a single stock, the index can actually provide more stable income and yet lower volatility. Right. If you look through a 10-year period, the index maximum drawdown is actually 22%. versus some of the big boys, and you could see that sometimes due to the single risk counter exposure, some of these big boys have actually more than 22% maximum drawdown. So again, because of the diversification, right, it helps you to narrow, cushion to lower the drawdown experience during adverse periods. So to summarize the benefits of the iEdge S-REIT Leaders Index, the leaders portion, the large and mid cap S-REITs has actually shown to have better performance in the last 5 years. Now, with the liquidity adjustment strategies, that follows fund flows and sector rotation, right? Especially into the S-REIT sectors that we could recently see, that attract a new capital inflow consistently. Those sectors, those fund flows are actually being mirrored or shown in the daily traded velocity. And then those REITs and those sectors will have, being rebalanced to have a heavier weight on the index itself. And that's helped the index and investors to stay relevant to market situation, right? Lower volatility if you buy into the index and ETF compared to a single stocks and also compared to other risk indices out there. Lower index turnover, we only rebalance semi-annually. That helps to lower rebalancing costs as well. So the weighting towards the large and mid caps, you could see that for the last 10 years, he has actually outperformed the smaller caps in terms of total return, annualized return. So this results, these large and mid caps have a higher weighted weightings in the index itself. So if you liked what you see right now, there is an ETF that tracks the performance of the index, right? The ETF would be our ETF by the name of CSOP iEdge S-REIT Leaders Index ETF. There are two currencies that actually will be traded on the exchange upon listing on the 18th of November. The Sing dollars ticker code will be SRT, right? The US currencies will be traded with ticker code SRU. So SRU will be available on the 18th on the stock exchange. And right now we're actually going through a fundraising phase, which I think the moderator will share more in details, but I'll leave it to that. And how our portfolio manager will invest into this index is actually through a full replication strategy. That means what we will buy into the underlying S-REITs. We do not use derivatives. We do not do into swap agreements with other counterparties. We will actually invest into directly and own the physical stocks of the S-REITs underlying constituents. And having said that, due to that replication strategy, this ETF is an EIP product or executed investment product. You don't have to declare your trading experience or your education kind of thing. It's suitable for all investors. And when do we give dividends? We do give out dividends semi-annually in Sing dollars, right? And the beauty of this ETF is actually we kept the total expense ratio of this fund at 0.6% of the net asset value annually, right? So this includes our management fees of 0.5 and we kept it at 0.6. So to you as investors, the cost to own this ETF is actually at 0.6%. That is your maximum fees that you are paying for running this ETF. Yet you are actually passively investing into the active rebalancing of the index based on the liquidity adjusted methodology. Why not, right? Let me say that this ETF offers easy access to the real estate market, as these S-REIT big boys are actually buying into geographically into other countries' assets outside of Singapore. This offer, by owning this S-REITs ETF, you're actually owning this underlying properties overseas and in Singapore as well, right? You're owning a basket of high quality S-REITs that have exposure to different industry, different countries, different sectors, right? And because of the ETF, it has an smaller average bid and ask spreads, definitely will help you in terms of a total return. You achieve the maximum diversification benefits if you were to buy a single REIT or even to a physical property, right? You have a higher diversification in that sense. Liquidity, you also have the highest because we have an army of market makers quoting a very tight bid and ask spread, having a highest liquidity being offered on Singapore Stock Exchange, When you talk about transparency, you know that we are tracking this index. This index has a very strict and fixed guidelines. You know what we are investing into, what goes in and what goes out of the index is very transparent to you. You know what you're investing into. In terms of dividend yield, right? A physical property gives you about a yield of rental yield about 3%, while a basket of S-REITs, as I did mention, forecast that for the work year by Bloomberg work year 2022 and 23 will come in at 5.4 and 5.6% dividend yield, gross dividend yield. The beauty of this is actually by investing into a S-REIT ETF, you are tax exempted. So you know at individual level, you will not be taxed on the dividend income received by a basket of S-REITs. Right. Versus, if you buy a physical property, you have to pay 10% tax in terms of property tax. So again, tax-wise and cost-wise, is very efficient via buying an ETF rather than owning the individual REITs or physical property. So if I were to humbly, put ourselves with the peers right now in the market, right, you could see that because of the selection process and also the liquidity adjusted kind of rebalancing of portfolio, you could see that the index, the gross index, right, the annualized return over a 5-year period, right, have actually outperformed the rest of the indices, right, of 8.37%. Dividend yield is actually also very in line, and you could see that because of large cap has actually higher, potentially higher price appreciation, it helps in terms of the annualized return. So to summarize, is it time to invest into the S-REITs? Definitely, it's definitely in time to invest into the S-REIT leaders as the economy starts to reopen, right? Like we said again, we are very overweight in terms of industrials. That includes logistics as well, due to the e-commerce, due to the e-commerce, and of course due to the COVID-19 that actually disrupt the shift in terms of supply chain as well. For data center as well, we see that we are doing more shopping online and using mobile phones in terms of apps. Netflix, data center is actually very important for those apps. For retail and office, we believe that the worst is over for them. We have actually a very positive medium outlook for grade A offices, right? So, and for hotels, definitely we're still under pressure. We expect to benefit from the pent-up demands once more VTL lanes are introduced and more vaccinations is being agreed, and we open up our borders. So let me summarize what has been said in this webinar. Right, this ETF and this index offer the best of both worlds, both sides of the scale. Right, we put in large cap S-REITs because they have quality assets, they have very strong sponsors and very strong management. They ride on the economy of scale. They have actually, with that, they have actually have a higher potential in terms of growth, in terms of valuation, and in terms of price, and yet very liquid. On the flip side of the scale is that we put in mid cap S-REITs is actually because they have bumped up because they offer a higher dividend yield, very stable and attractive cash flow. They also offer sectors diversity into the portfolio and representation of different subsectors as well. By funneling these two together into the index and into the ETF, it actually offers investors a smarter way to build your real estate portfolio. It helps investors in terms of cost and also in terms of managing your tax effectively. Last but not least, because of the liquidity adjustment rebalancing to keep the index and the ETF relevant to the economic situation, that will actually help the investors to stay relevant as well. Very strong, attractive dividend yield of 5.4 and 5.6% gross of the index at for work year 2022 and 2023 based on Bloomberg forecast. Offers in terms of diversification, in terms of geographical sectors, and in terms of asset class as well. Very stable asset values because when you put in the big boys and the mid caps into this index, and also buying into a basket of these established REITs offer lower volatility and turnover to investors. And with that, I reached my end of my webinar, and I would hand over to Jonathan.
Thank you for sharing this afternoon, Adrian. Okay, right now I'm going to share my screen I'm just going to take all wonderful attendees today through a little bit of a process of how you can begin to do the online subscription for this ETF if you're so keen. So the online subscription is open during the IOP period. That will be from 29th October till 15th November by 9:30 a.m. Okay, so we've actually published an article. You can find all that information in this article. I will drop the link in the chat section for everybody just after this portion. So I trust that you can all see my screen here. So basically the first step is that you need to go log into your fsm1.com account, head over to live trading, and I've highlighted over there, click on the stocks and ETF link over there. That will take you to the live trading page, of course, and below you'll see all the prices. What you want to do is to click on the IPO and placements button. So again, I've highlighted that there. You'll see this on your screen. And once you click on that, you will see the CSOP iEdge ETF that Adrian has just talked about. You'll see that listed over there, and that is available until the 15th of November for subscription. So right on the right-hand side, there's the green button. It says subscribe now. So you just click on that, and then this screen will be brought up. Okay, and then what you want to do is to insert the quantity of units which you want to subscribe to. And then after that, you will click and accept the terms and conditions. And then you just need to scroll to the bottom and then just to click confirm. So upon the completion, the successful completion of your subscription, you'll receive an acknowledgement email regarding the order. And then after that, after the IOP period, once the allocation is completed, we will inform you of the allocation results. For this IOP, the allotment for this issue will be in full. So that's again subject ultimately to the receipt and clearance of the funds which you need to have in your cash account. So there'll be no balloting. So as long as your monies are in place, you'll receive the full amount which you have balloted for. Okay, so again, I will just drop the link to this article and the instructions in the chat function. You can go read through the article, and if you have any issues, you can contact us. So with that, we've come to the conclusion of this afternoon's webinar. Thank you all for coming, and stay tuned to fsm1.com as we continue to bring you more educational content like these. Other than that, I wish you to stay healthy and all the best with your investments. Thank you, everyone.
Thank you all. Stay safe.